Hi everybody, it's Brett here from Metropole. Today we're going to be talking about the difference between physical growth and capital growth and why it can be quite difficult to distinguish between the two because quite often physical growth hides itself in the capital growth statistics, and you'll often find capital growth, I feel, is the best way for beginning investors to grow their asset base and create a level of wealth. So by targeting the 5, 10, 15 year capital growth trends, you're going to get a list of suburbs, but now you can start to find the difference between the contenders and the pretenders. So physical growth areas are quite often that, areas that have had a huge amount of physical growth. Maybe 5 or 10 years ago, there may have been cows, sheep, or koalas living there. So all of a sudden, there's new housing estates popping up. There might be a school, there might be a library, KFC or McDonald's jumps in there. There's all this physical growth happening, stage 1, stage 2. And you get an instant burst of, I guess, growth because, as I said, years ago there was nothing there, and now there's this little area that's housing estates that are popping up. And that's where it's dangerous because the statistics tell the story there. But what happens is there's too much supply of new land. You can keep building out there for the next 5 or 10 years in some cases as blocks get smaller and smaller and areas start to increase. There's a hell of a lot of physical growth going on, and demand starts to drop considerably. Who's going to want to rent my property or buy my property that's 1 or 2 years old when they could spend a little bit extra and buy or rent another property? And it's a really dangerous cycle to get into. So stick to the fundamentals of supply and demand. If we look at stronger areas with consistent above average capital growth, the supply and demand ratios are different. There's no new land available in these established locations with historical history of capital growth, and there's huge demand because of jobs growth, employment hubs, lifestyle precincts, top schools, public transports, all those different things. So it's really important to understand the difference between the two. Even though sometimes an area with physical growth may outperform in a 2 or 3 year period, it's the longer term statistics you need to follow, because even a 1 or 2% difference in those returns compounded and annualized over a 10 or 20 year period could cost you hundreds of thousands of dollars and a huge amount in opportunity cost and foregone equity and opportunities as well. So that's the difference, and that's why you need to understand the difference between the two, because it could make a difference to your personal wealth. Thanks for watching.